The banking sector is getting pressured downward. Specifically, when you look at KRE stock and you look at the regional banks, you realize that there's a lot of pressure brewing. Interest rates look likely to move higher, and it's affecting the regional banks a lot more so than, say, XLF stock, which will have the bigger stocks, bigger banks inside it. XLF stock is the financial sector. It's an ETF that follows the financial sector, and you get the bigger players in there. Those stocks tend to do better in adverse environments simply because they have more tools at their disposal and they hedge a little differently than what a regional bank could do. With interest rates moving higher, valuations on the books for these banks are going lower. So the banks have to lend less. They have to recoup those losses somehow. This is pressuring KRE stock a lot. I wanted to take a look at this and kind of explain what's going on, because understanding the banking sector gives you a broader aspect of what's going on with the entire economy and financial markets. Let's take a look at KRE stock and XLF stock. Let's jump in. Before we jump in, this is a breakaway channel from my original channel. Make sure to hit the like and follow button. As well, look down below. I've got links to my other channels as well as my website, dhtayloranalysis.com. And you can pick up the free email newsletter whenever I do content. I send out an email. That email is growing quickly, that email list. Now let's jump in. Here's the culprit right here. This is, of course, not the cause, the effect overall. Inflation is sticky. This is the 10-year Treasury yield. And as you can see, we had a bit of relief buying, if you will, because of geoglobal factors. That is reversing, and we're seeing the bond yields heading right back upward. Stocks sold off heavily today. KRE stock and XLF stock went down as well. So as Treasury yields increase, and I mentioned this in the intro, what happens is when bond yields go higher, there's an inverse relationship between price and yield. If yields go higher, price goes down. So if a bank's sitting on, say, $100 million in Treasury yields that they have to keep on their books, as the yields go higher, those values, the valuation for that portfolio goes downward. So the banks have to make that up somehow. They have to retain, they can't lend out as much, they'll retain some capital in order to keep their books in line with what's going on. So inflation is what is driving the Federal Reserve to do what it's doing. There's also other outlying factors, of course, the now two wars. You also have the deficit, U.S. deficit, and several other factors are pressuring interest rates higher. This is affecting the stock market. It will affect consumption. Consumers will contract. Those will in turn force banks to tighten up even further. So inflation is really one of the key factors with, of course, the money supply. And that is the cause, the effect on that is higher interest rates. But that higher interest rates is the cause for, this is KRE, the ETF for regional banks. Now I follow this, I've been following this for a long time. It gives me an idea as to what's going on with consumers and the regional banks. And as you can see, today's movements were to the downside. A lot of people are saying that this is going to get pressured even further. But let's take a look at KRE stock versus XLF stock. I mispronounced that a little earlier in the intro. If we go backwards a handful of years, you can see that there's a pretty strong correlation to price movement, but KRE hasn't really kind of moved upward as much. Then in March, of course, this is March of this year, we had a bunch of chaos going on with a bank going belly up out in the West Coast. And you can see how KRE stock, the regional banks, took a hit because that bank had to get consumed. It's no longer. From there, the question now becomes, how much more damage is there going to be? If the Federal Reserve continues to push interest rates even higher, these regional banks are going to have to lend even less and make up for their losses in their portfolios somehow. Those losses are going to translate into losses in the companies themselves. Now, again, XLF, the total financial sector with the bigger banks, the JP Morgans, the Morgan Stanleys, Citi, and others, they've got other tools. They've got other resources. They can hedge differently. They got profit centers that are different than just a plain regional bank. Because of that, their losses are less than what you're seeing here. But by and large, you're seeing kind of a trending move that's about the same. And so I was talking to a buddy of mine, one of my guys, and he said, well, can XLF go to zero rate of growth over this period of time? Well, it's already been there. We look no further in 2020. Of course, 2020 was COVID. Since then, profits have lit up for XLF, the broader financial sector. But yeah, absolutely, that could happen. You could see banks starting to take losses because interest rates went too high for too long. Higher for longer. We keep seeing this permeate throughout everything. It has ripple effects throughout the entire economy. So to see XLF, the region or the financial sector itself, go to zero on profits over this entire course of period of time is a probability and a possibility. But what would that do with KRE stock? KRE stock, of course, would probably bottom out even further. You might see this thing go negative 50% overall during that period of time. Maybe. We'll see how that plays out. So the question becomes, how much higher will the Federal Reserve have to go? We have economic data coming out Thursday and Friday. Thursday, we get another look at GDP. This is a revision. Usually comes in right about where it was the previous month for the quarter, but sometimes you do get surprises in there. That second revision as well as the third revision, so we'll see how that goes. But the real thing for me is PCE indicator inside personal consumptions and personal income Friday. PCE is the inflation index that the Federal Reserve looks at. They don't look at CPI. They look at one of them. We get CPI 2 weeks before PCE is announced. It's basically the same thing. There's a little bit of nuance there. We're seeing some moves upward in inflation. This could easily push the Federal Reserve to push interest rates higher for longer. Then next week, we get unemployment. Unemployment's running at like 60-year highs or lows at 3.8%. It's off from its ultimate lows of what, 3.4, 3.5? Still, 3.8% is exceptionally low. The economy is still moving fast forward, and the Federal Reserve is going to want to contract that. At the same time, they're trying to contract M2 money supply. This constricts banking. If the Federal Reserve constricts M2 money supply, the mechanism is higher interest rates, cutting its own portfolio. Banks will lend out less. That's the lubricant that keeps the economies moving. Fractional banking. There will be less loans. Businesses will take out less loans because they're too costly, and there's a rationing mechanism with less money supply. KRE stock, XLF stock, go lower. So the next couple of inflation reports are going to be really hyper important. If we start to see a mellowing out, KRE stock could do exactly that, mellow out and then move higher. Certainly XLF stock would have the ability to move much higher because those companies have the ability to really kind of hedge and move forward from there. So we're really data dependent at this point. My take is we're going to see more inflation. We're going to see the Federal Reserve raising interest rates even further, maybe another 25, 50, 75 basis points over the course of the next 6 months. This will begin to contract the economy even more. KRE stock drops even further. XLF stock, maybe it gets down to zero with growth overall for this period of time. This will be ongoing and developing. I'll continually be updating you on this channel. Make sure you hit that like and follow button. Make sure you follow up for my other channels down below, the links, and of course, dhtaileranalysis.com with the free email newsletter every time I send out content. We'll see you in the next video.